Good afternoon. I'm David Robinson, the James and Gail Vandervelde Professor of Finance at the Fuqua School of Business. I'm very happy to be back with you today to talk about recent changes in legislation that will allow retail investors to invest in private equity through their 401k plans. But before I dive in, let me start with a brief announcement. Today's talk is part of an ongoing series. Every Wednesday at 12:30 Eastern Time, Fuqua faculty come to you live on LinkedIn to talk about applications of their research expertise to current events going on around us. Next week, we're very pleased to have Professor Emeritus Ralph Keeney, who will share practical ideas about how to take an innovative approach towards nudging yourself to make smarter personal and business decisions. That's next week. Today, I'm going to talk about recent changes that allow 401k plans to invest in private equity. I'm not going to tell you whether you should invest your own retirement savings in a plan that offers exposure to private equity. Instead, what I want to do is I want to talk at a more macro level about economic forces that have played out over the last 20 or 30 years that have kind of brought us to where we are. And if we do that, I think if we start there, then it'll help to highlight the promises and pitfalls that this opportunity represents for ordinary investors like you and me. Before I get going, I just want to say from the outset, if you have any questions, please post them in the chat window. You can interject with a question at any point. And in fact, I would love it if you would post your questions now. It'll help me. Because what I'm going to do is, first, I'm going to talk about two major trends that have played out over the last 20 or 30 years. Then after that, I'm going to talk about two reasons why these trends matter a lot. And then finally, I'm going to talk about three caveats that we should bear in mind before we just sort of embrace this transition wholeheartedly. So if you go ahead and offer your questions now, that'll help me organize our time together better today. Thanks a lot. Okay, let me just jump right in. To understand why this change is so important, we need to take a look at two big macro trends that are crucial for understanding where we are right now. The first trend is that over the last 20 or 30 years, we've seen an enormous transition from defined benefit pension plans to defined contribution pension plans. That's been something that's played out at the corporate level in terms of most corporate pensions being structured as defined contribution instead of defined benefit. But it's something that's played out also at the national level. You know, for example, the country of Sweden in the 1990s restructured their pension system to make it look a little bit more like a defined contribution system. And so this is something that's been played out, across the globe, beginning sort of in the late 1980s, early 1990s. That's one trend that's super important to understand. To give you an idea of the magnitudes that we're talking about here, and I'll come back and talk about this number later. Right now, in the United States, there's about $3 trillion sitting in 401k plans. And about 20% of that sits in what are called target date funds. So, you know, that target date is like, if I think I'm going to retire in 2060, I invest in a 2060 fund and it adjusts its exposures over time, taking risk away the closer I get to that 2060 retirement date. So bear those numbers in mind, $3 trillion in 401k assets and about 20% of that in target date funds. That's one very important trend. The second trend that is equally important is that we've seen an enormous rise in the importance of private capital. If you go back even to the early 1990s, that was a time when venture capital was already well established. But if you just go back to the 1990s, the total size of the private equity asset class was maybe $10 billion of committed capital. Now, that's not to say that they weren't doing bigger deals than that. So, for example, a lot of people are familiar with the story of, that gave rise to the book Barbarians at the Gate. That's KKR's takeover of RJR Nabisco. That was a $25 billion transaction. It was financed, however, with a relatively small amount of KKR's own equity. So this equity piece was about $10 billion if you add it up across the whole sector in the early 1990s. Today, it is about 100 times larger than that, maybe even more than 100 times larger than that. So now we're talking about the amount of equity capital that's committed to private equity would amount to the trillions. Okay, so those are two hugely important trends. Dramatic shift in the way retirement funds are allocated, moving from defined benefit to defined contribution, and the enormous rise of private capital. Now, people have speculated, and there are many reasons why we see this rise in private capital. I mean, part of it is that, changes to, private companies have stayed private longer. Venture-backed companies are waiting longer and longer to go public. Dodd-Frank legislation made it harder for banks to take certain types of risk. That gave rise to private credit funds, private debt funds. Leverage has been very inexpensive to obtain, and so that's fueled a lot of interest in buyout funds. And also, there's just sort of a capitalism on steroids governance model that sits behind buyout that has been very successful, frankly, in a number of instances at creating value. So all of these factors, it's very hard to determine, which is more important at a point in time. This has sort of created a perfect storm that has created a huge surge in the total amount of private equity in our economy. So those are two big trends that are important for understanding why we are where we are. Now, why do these things matter? Well, if you're a private equity manager, a general partner in a private equity fund, you've been clamoring to access 401k savings for a long time. Historically, corporate pensions and pension funds in general were huge investors in private equity. The basic private equity model was one where private equity managers, the general partners, raised funds from pension funds, other types of institutional investors, and called on that capital when they identified attractive investment opportunities. As this first trend has played out, we've seen $3 trillion of capital kind of leave that institutional sector and go into 401ks where we're off limits for private equity investors. So they've been clamoring to access this market for a long time. And in fact, if you go back to the time of the global financial crisis, we were starting to see some of the behemoth private equity funds, Carlyle, Blackstone, Apollo, actually do something that almost looked like they were going public. They were listing sort of something that was like a share of equity in their partnership. And that was an attempt to access this market. That was an enormously costly and complex thing for them to do from an organizational standpoint, which just shows you how important it is. Also, as we've seen the corporate tax rate come down, you're seeing increasing numbers of private equity funds restructure themselves, instead of being partnerships, being C corporations. And again, that's partly to reduce the cost and the complexity of reaching out to public markets for additional funding. So that's an important issue. Private equity, part of the reason why we're in the world we're in is because private equity has been clamoring for a means to access 401k savings for a long time now. Okay, the second reason why this matters is that private equity has outperformed public capital markets pretty substantially over the last 20 or 30 years. So to give you kind of a rough number, we're talking about overall, we're talking about 2 to 3% per annum in excess performance over what you would have earned in a public equity index. Now that matters. It's easy to forget, but it's easy to forget the importance of small differences in returns when they're compounded over long periods of time. So if, for example, you take $1 and you invest it for 40 years at 5%, you're going to come out with about $7 on the end. If that same dollar invests at 7% instead of 5%, over that 40-year time span, you're going to have $14, twice the amount of money as you would have at the lower interest rate. So relatively modest seeming differences in returns once you compound them over your entire work-life retirement savings cycle, can have huge impact in the amount of retirement funds you have available. So that's an important reason on the other side why this is sort of a historic moment, that when 401k plans can invest in private equity. It's both an important source of capital for private equity as an asset class, and it's an important source of retirement returns for retail investors who have been shut out of private equity by and large over the last 30 years. This is a bit of an aside, but when we talk about inequality in this country, we talk about the dramatic rise in the amount of resources that are commanded by the top 1% or 0.1% or whatever of this country. A lot of that growth has come through their ownership of assets, not their income. And so because we've had a defined contribution system that's kept the middle class out of earning these higher returns, that's a problem it's introduced long-run structural problems in our retirement system. So those are reasons why these trends matter. So that kind of sounds all good, right? Private equity has more capital. Retirement savers have more opportunities. How should we think about this? Well, there's three caveats that I want to bear in mind. And before I do, though, I see some questions coming up through the chat window, and I want to pause for a second just to take a look at the questions. So a number of people are asking, when 401k plans can access private equity investments, what is the risk for 401k investors? And that's exactly what I want to talk about. That's a hugely important question. I think actually there's three caveats that we need to bear in mind. The first caveat is that when we think about private equity earning abnormal returns over public capital markets, we have to bear in mind that nothing in this world is free. And so if you're earning excess returns, then you're being compensated for bearing some kind of additional risk. In the case of private equity, it's what we call liquidity risk, or rather illiquidity risk. See, if you're invested in a public index, you can adjust your exposure to that index very easily. Stocks, you can buy and sell stocks in the blink of an eye. So that means that portfolio adjustment decisions are very easy to make. And it also means that if you need to come up with a lot of cash quickly, you can liquidate your public equity portfolio and access cash. That's not true in private equity. A private equity investor makes a long-term commitment to a fund. Those funds are tied up for long periods of time. You don't see the returns to that until many years down the road. And so that liquidity problem, some households may be better positioned to bear liquidity risk than others. And that's a super important factor to bear in mind. If you're a young investor, somebody who's just showing up to business school, you probably would benefit from having some exposure to a really illiquid asset class, because you really aren't going to be tapping those retirement savings until much later in your life. And so you can afford to ride out that illiquidity. But 401k investors who are closer to retirement might find this less attractive. That's one thing to bear in mind. There's, one alumni is writing in with a question, or is this going to result in 401k investors holding the dirty side of the bag? And that gets to my second caveat, which is that if you look at the spread in performance in private equity markets, it's much more extreme than the spread in performance that you see in public equity markets. So what I mean by that is that if you think about just sort of a modestly good versus a modestly bad mutual fund, the difference in performance between those two funds is not so severe. If, on the other hand, we think about the difference between a modestly good private equity fund and a modestly bad private equity fund, the difference in performance is enormous, orders of magnitudes further apart. So what that means then is that picking the right manager in private equity is critically important. Being able to access top performing private equity funds makes the difference between doing well doing about average, or doing poorly. So those are two caveats. The third caveat, and it ties back directly to Ramesh's comment about holding the dirty side of the bag, is that private equity is, after all, private. So because the asset class is private, it's not subject to the same disclosure rules that govern public investments. And that means that as investors in private equity, you don't have the same transparency that we're used to in other investments. Fees are opaque, they're complicated, they're hard to understand. They're hard for pension fund managers to understand. In fact, the SEC is involved in litigating against private equity funds precisely because of the confusion in the fees that they charge their investors. So, you think about that, the ordinary retail household investor may not be well equipped to manage that level of complexity and opaqueness. And if you put these three caveats together, illiquidity, a huge spread in performance between good managers and bad managers, and a lot of institutional opaqueness, you could find yourself allocated to a poorly performing private equity fund and not even know it for a long period of time. And then that's sort of the worst case scenario, because if you think about it, think about what I was saying earlier about small differences in returns generating big differences in total amounts of retirement wealth at the end of your working career. Well, by the same token, if you've invested in a little bit worse private equity fund than someone else, then that's going to result in you having that much less retirement savings in the future. So I think those three caveats are critically important to bear in mind when we think about kind of where we stand at this moment in history, thinking about the potential for 401k plans to invest in private equity. Now, I see a question. Are you saying that I can now allocate capital to a private equity fund with my 401k plan? Actually, it's not that simple, and it's probably a good thing that it's not that simple. Right now, it is not possible to direct some of your 401k savings directly into a private equity fund. And it is unlikely that will ever be the case. Part of the reason for that are these liquidity issues that come about. It would be hard to allocate capital out of your 401k to a private equity fund because it would be called down in a very lumpy manner, and that liquidity needs to be managed because people are coming into the fund and coming out of the fund. And so what's going to happen is the current rules say that that target date funds, and again, that's about 20% of that $3 trillion in 401k funding out there, target date funds are going to be able to allocate a portion of their portfolio to private equity. So what that's going to mean then is that you as an investor are going to be able to make a choice when you look at a variety of different target date funds. You'll be able to pick one that offers exposure to private equity. What's going to happen then? Well, the management team of that target date fund is going to act like public equity managers, but also private equity managers. They're basically going to be running a fund of funds inside that target date fund, where they're going to try to build a diversified exposure to private equity, over different vintages and over different types of investment styles. And so they'll be the ones who are responsible for dealing with this manager selection piece, this second piece this caveat that I was saying was so important. But what that means then is that we've added an extra layer of administrative complexity into the decision. And it also means, if you think about this, that that target date fund is going to have to hold larger cash reserves or larger reserves in very, very liquid assets in order to meet the capital calls that it will face as its allocations to private equity draw down their capital. So I think those factors are going to place a bit of a drag on the returns that you can expect to earn in private equity relative to what you would earn if you were, let's say, the Duke University Endowment or Yale Investments Office, or some large state pension fund that has direct access to the private equity investment itself. So I think that's I think those are important things to bear in mind. I know we have time for a few more questions. So Linda Jordan is asking, as an individual to invest in private equity, don't you have to be an accredited investor? Most 401k participants are not. What are my thoughts on this? Well, Linda, this is a really important point you're raising. And it gets, I think this is precisely why we have the target date fund managers acting as basically intermediaries on our behalf, kind of making the asset manager selection decisions. Because you're right, they, most 401k participants are not accredited investors, and even the ones who are don't necessarily possess the detailed kind of institutional specific knowledge that they would need in order to evaluate different private equity investment alternatives. I mean, to be honest with you, this is something that academic experts debate. Is like we can't even agree on the right way to measure performance in private equity because it's such an unusual asset class. You have an investment that's made and then it may not mature for 5 to 7 years. The investment is made in several tranches. The exit occurs in several tranches. It becomes very difficult to make easy to understand performance attribution statements in this world. And so even, being an accredited investor in itself probably wouldn't give you the requisite knowledge to make informed decisions here. I think that's a hugely important question. So Manju Reddy, hi Manju, is writing, with companies preferring to go public via an SPAC compared to traditional IPO route, with VCP access to 401k, do you see a lot of companies going public prematurely in order for venture capital and private equity to exit in more favorable terms? That's something I'd never really considered, Manju. That's a great point and great question. I mean, certainly I think that what's happening is venture capital and private equity investors are interested in exiting their portfolio company investments, and they want to do it in as orderly and as low cost way as possible. And sometimes these special purpose acquisition companies, these SPACs, do provide a very attractive way for, so basically what happens is the private company that you've purchased, you're a buyout fund and you're holding, or venture fund, and you're holding this private investment, and you could take it public directly by going through the IPO process. But instead what you do is you basically just sell it to a shell company that's already publicly listed. And so it's kind of a backdoor to an IPO through this acquisition channel. And I do think we're going to see more of that. And it's just a classic illustration of a tried and true premise in capital markets, which is that people try to find a way to take away pain points. And when the IPO process is complex, that creates incentives for people to try to find workarounds. So let me see. I see some more questions. There's a lot of great questions here. Thank you for these questions. It's going to take me a second just to read them. So Sarah Tomar, hi Sarah. Your question isn't what I've just described, offering exposure to fund fees rather than a portfolio of private companies. And I think that's exactly right. I mean, I think that when you're an investor and you're thinking about directing some of your savings towards a target date fund, you should look at the private equity exposure in that target date fund as a fund of funds. And how do we think about funds of funds in the traditional sense? We think about funds of funds as you put your money into the fund, there's a layer of fees and carried interest sitting at the fund of fund level, and then they're directing your money down into the primary funds where there's an additional layer of fees and carried interest. And so allocating capital this way is adding fees on top of fees and adding performance fees on top of performance fees. And I think that although it will be packaged differently in terms of the communication to the target date fund investor, I think from an economic point of view, it's going to work very much the same. That the Vanguards, the Fidelities, the T. Rowe Prices in the world are going to be offering this as kind of a fund-to-fund structure, and there's going to be an extra layer of cost. Now, I say that, and it's important to bear in mind that this 2 to 3% per annum excess return that I told you about earlier in the half hour is really that's a return that's net of fees. And so there is clear evidence that private equity outperforms on average, but because there is such a spread in performance and because returns play out over such a long time, the cost of getting locked into a poorly performing fund are high. And that's part of the reason why a fund of funds model may make sense for a lot of people, because it diversifies your exposure and doesn't lock you into one fund or another. But Raghavendra, it will definitely increase administrative costs. There's no question. It's much more difficult to maintain the kind of due diligence and relationship management in private equity than it is in public equity. We've maybe got time. We're almost at the end of the hour here. We've maybe got time for one more question, and then I'll just wrap up. So Keith Ellison raises the question, could this lead to more capital, thus more competition among funds chasing limited deals and driving down returns? That is a fascinating observation, Keith. I think that's absolutely right. I mean, if what happens is we open the door to more capital coming in, then we could just see the size of the private equity sector grow by even more. We have more people chasing the same number of deals. What is that going to do? Well, that's going to drive up deal prices, and that's going to create a lot of value, but not necessarily for the investors in private equity. It'll be for the target companies that are getting purchased. So how that plays out in this weird kind of general equilibrium where you've got buyers and sellers and investors and managers, it's you're wise to point out these general equilibrium implications, because it certainly could drive down returns. And I'll just end on one final note off of this. Some people have looked at private equity performance over the recent period, like over the last 10 years or so, and have said that, private equity relative to public markets hasn't done very well. Well, partly that's because private equity earns a return for providing liquidity, and we're sitting in a capital market that is really flush with liquidity. A few weeks back, we had Professor Anna Chieslak talk about her work kind of decomposing stock market returns. And, she shows very convincingly the role that the Fed's balance sheet injections of cash into the economy have played in elevating stock market prices. And so that's another factor, is that as we start to take away liquidity, that's going to change the dynamics of how the acquisition process works in very tricky ways. So with that, I should probably conclude. And first of all, I want to thank all of you for your questions. This has been a lot of fun. This is a topic that hits on two research areas that I'm very passionate about: private equity and also retirement planning and financial literacy. So I'm very happy to have a chance to talk with you today. I really hope that you'll tune in next Wednesday at 12:30, and in fact, every Wednesday at 12:30. Just to remind you, next Wednesday at 12:30 Eastern, we're going to have Professor Emeritus Ralph Keeney. He's going to share with us some practical ideas about how to take an innovative approach towards nudging yourself to make smarter personal and business decisions. Thanks a lot. Have a great week.